Bank failures. This year, the number of bank failures fell to levels not seen since before the financial crisis. On the surface, it suggests the nation's banking system is healthy again. But as Mary Thompson reports, a closer look suggests that troubles remain.
Only 24 U.S. banks failed in 2013, the lowest number in 6 years, according to the FDIC. Well off the peak of 157 during the financial crisis, 2013's failures represent a minuscule 0.3% of the country's more than 6,800 FDIC-insured institutions. A stronger national economy and aggressive oversight by regulators helping to stem the rate of failures, though it's premature to say the banking system's fully recovered from the trauma of the financial crisis. Consider this. The number of banks the FDIC considers troubled remains elevated at 515, or 7% of the nation's total. Among the challenges all banks face, the continued low interest rate environment.
The abnormal interest rate environment in which we're in, which makes it impossible for banks to do lending, to get sufficient yield on the loan versus the cost of funds, to produce an attractive return.
This profitability problem especially acute among smaller banks. Why? Many operate in regions where the recovery's been slow, hurting their business. With a focus on local customers, their lending portfolios are less diverse, and they may find fewer qualified clients as banking inspectors push them to improve loan quality, all making it harder to make a buck and the extra dollars small banks need to pay for the higher costs of new regulation.
It is a good business if you've got the scale. For the first time, the size does matter.
With bigger being better in banking these days, industry experts are expecting a pickup in mergers and acquisitions among small banks. Shrinking their numbers by combining to increase their size could prove the cure for banks still ailing from the financial crisis. For Nightly Business Report, I'm Mary Thompson.